All right, how's it going, everybody? Hey, Gino, Jake, how are you guys doing?
We're
Doing
doing
good.
great.
How are
How are
you?
you?
I'm doing good. Doing good. Apologize, I'm not on video. I'm actually traveling in California right now, but hopped on just to say hi and introduce you guys here in a little bit once we kick off.
Looking for your name, Ferris. Where are you? You're on page 1 or page 2?
Any page you need me to be on. I have no idea relative to you. So.
Oh, I hear. I see. I sorry. Multifamily Masters. There. I see you. I got you.
Yeah, how are you doing, Gino?
I'm doing good. We haven't seen each other since January. We were out in
Oh no,
Tampa.
it's been a long 6 months.
And how have you been doing deals? You closing any deals since then?
We've been busy, definitely closing and selling and just a lot going on. So kind of we sold a deal, selling a deal, and buying, you know, 3 more here soon. So
That's excellent.
a lot going on.
Congratulations. That's great. That's good. That's excellent.
How about yourself?
We have done a bunch of small deals, 25 units, 60 units, all nothing syndicated, just all bought in house. Some of our employees have invested in deals, and we bought a 67-acre piece of property, 70-acre piece of property. And it looks like we're going to go to build to rent also. So we're looking to do a little development as well. You know, as the market cycle changes, you know, if it doesn't work in the next year, 2 years, we still got this land, and it's going good. But there's deals definitely coming down the pipipeline. We're putting
A lot of
offer
shit
in
hitting the
since-
market too.
Yeah, a lot of stuff.
There's a ton hitting the market. I think you have all of those sellers that were contemplating, riding it out, and then now they're freaking out. They just want to cash out. And
And
yeah,
Ferris,
we have
you
a
know,
deal that's closing in 2-3 weeks, and hopefully, kind of, gets across the finish line here soon.
and you know what's nice? Brokers are actually calling back now. They're actually calling you up, and they're trying to do some cold calling and trying to get the word out, because it seems as if there's a lot of people on the sidelines right now, people not making offers, and I think pricing is getting shifted downward as we see, and people are just
I mean,
The posture front is being attacked a little bit, right? It's kind of nice to see a little bit.
It's so refreshing to see
no,
that.
absolutely. Even as a buyer, you finally have some leverage.
Yes.
Oh, you're a
we've
human.
been
I can
kind of
speak
using
to
that.
you.
Yes.
Yeah, so it's been interesting. I mean, our phones have been blowing up, especially lately. I mean, brokers know us to just kind of, drive things forward and get the closing, and just all sorts of stuff that's coming. We're seeing about a 10% price drop across the board,
which is great.
This has been kind of interesting. It's about finding the deal where, even though you get the pricing discount, making sure that with the interest you still can yield, a decent return. So
It's awesome.
yeah, it's been interesting to say the least, of just the amount of volume. So you have people on the sideline. I was talking to a broker yesterday. Literally said you have two people right now: people 100% on the sideline, or people that are just working through and figure out how to get deals closed. Period. So.
Well, Ferris, I've been saying this to the Jake and Gino community for the last 4 years. We've been saying for the last 4 years the market's at a high. So people have been on the sidelines now that the market's been on a high. Now that the market's, we're going into some type of recession or something, now they're freaking out because there's a recession. So they haven't bought for the last 4 years because it's been too high. Now they're making an excuse that we're going through recession. So it's only a good time when you're ready mentally, and when you have the skills, when you've learned all the different techniques, and you've learned how to buy during the 3 pillars of real estate and what market cycle you're in, because you can buy when it's going up and you can buy when it's going down. You just need to know how to buy and what type of assets to buy. And we're going to talk about that today. But
Gino, what does that tell you though?
What does that tell me, bro? Tell me.
Dude, so much I'm not trying to be the woo guy tonight, but so much of this is mindset. Like everyone was like, "Oh, I can't wait," and this is like you hear this. I can't wait till the next recession. I can't wait for it to dip. And now you're getting feedback from people. Oh, I don't know if it's the right time for me. Market's not too good. So it's like people talk shit, but then when the rubber hits the road, they're fleeting. So
it's interesting.
We'll
yeah, it is. It's great. No,
Yeah.
it's a good time right now, I think.
Yeah,
Hi, Vlad. How you doing?
I actually had an investor today ask us why the returns of the current deal are less than the deal we did 6 months ago, and I'm like, it's a very different. Well, the cost of capital has gone up significantly enough. So of course,
yes.
you should be surprised if the returns are the same that we're presenting.
Absolutely. So what do you want to do, Ferris? Do you want Jake to share his screen? We'll
Yeah,
jump right
so
into this bad boy.
Yeah, give us a minute. Let us hear. Let's go ahead and we typically kind of give people about 10 minutes, so another 2-3
Awesome.
minutes, and then we'll go ahead and kick off. I'll do an intro, and then let other partners hop on as well, and let you guys kind of take the stage.
Sure. And if there's any questions while we're going through it, put in the chat box. Jake will have the control of the screen, and I'll just see if there's any questions. We love to be interactive. We have some type of prezo created, but we just try to go off the cuff. And if there's any questions, we'd love to answer while we're going through the prezo.
Awesome.
Yeah, guys, bear with me. I feel like a a millennial right now in my parents' basement. We're on the road as well. I'm in New York right now at my mom's, and then we're heading over to my wife's, and then we got to get down to the city for some things over the next week. So I'm not sitting in my mom's basement, but I'm sitting at the kitchen table, right, where my dad used to beat me. All right, so we're just trying to get your work
There's
done.
no shame in that, Jake. No shame in that, man. So
Is that why
we've
the
all been
sweat?
there.
I got the sweat on the
I'm
forehead. Is that why
sweating.
you're
I feel
sweating,
like
bro?
I feel like he's gonna be like, you didn't do your homework. What is this? I'm having like PTSD right now, man. No. Crazy though, crazy times here. We were just driving back from my grandma's, and I drove past this part of town, and I remember sitting there trying to sell corn. My grandfather had like a little garden and stuff, and it was like one of my first entrepreneurial ventures. He parked me at the end of the road. I was like, I tried selling corn right there, and I was like 8. An entire day got ghosted. They didn't even get one person to stop. And I'm not like a guy that just sits back. Like I got the sign up and I'm jumping these cars. These scumbags just keep going. Like you got to help kids out when they're trying to pump it for an entrepreneur, right? I was like, man. So now, my thing is whenever I see kids in the neighborhood, I always stop and get the lemonade. Even if it's like, I got to pay $20 for it because I don't got change. So,
First, this is a good question for you. How much would you have to build extra margin on an exit cap to accommodate 1% interest rate increase? You have an answer for that, Ferris?
So how much would I have to build in? Basically, you're saying how much am I increasing the exit cap to accommodate for a 1% interest rate increase?
That's what the question sounds as if you're asking. Yes, from Mr. Dwight.
Yeah, that's a loaded question in a lot of ways because ultimately it's about also, do you think demand for multifamily is there, right? So cost of capital has gone up, no doubt about it. So returns have gone down, and so yes, cap rates are loosely correlated to interest rates, but at the same time, right, there's still a lot of demand for multifamily, and so I don't think it's one for one, right? I think there's a plateau point, or maybe not plateau. I don't want to say plateau. It's maybe staircase is what I would kind of answer that, and so with a 1% interest rate increase, the math tells you to say 1%, but I think it's very still market dependent. It's anywhere from half to a point, somewhere in that range. But I think it's also not, I don't think it's linear. I don't think it's, if it goes up 3 points, your cap rates are going up 3 points either.
I totally agree with you.
Yeah.
Mm-hmm.
Yeah.
What's the background of most of the folks here? Is this like typically the syndication crowd? What's everybody do here?
Yeah, I'd say actually overall it is. You have kind of a mix of investors and syndicators, so maybe 50-50 is probably what I'd say.
Excellent.
So with that said, I'll go ahead and kick it off. So welcome everybody to I guess we call it the Texas Multifamily Masters. For those that don't know, Multifamily Masters is a national group that we put together many years ago, and essentially really having localized meetups and everybody essentially flying the same banner. So due to COVID, we decided to actually take this virtual and kind of combine with our Dallas friends and basically host a virtual version of this that we've been doing since COVID started. And so for those that don't know me, I'm Ferris Musa, one of the managing partners at Disrupt Equity and Disrupt Management. We're a vertically integrated firm. We have properties throughout Texas and Georgia, and really, hyper-focused on continuing growth in the Sun Belt. And so we're based in Houston, Texas, and continuing to keep that growth. And my partner, Ben Suttles, is usually on here, but we're both out here in Sonoma for an event, and so he did not make it on. We literally just walked into the hotel and I hopped on this call. So wanted to make sure I got to say hi and introduce Jake and Gino as well. So with that said, I will hand it over to my Dallas partners. John, you want to go next?
Yeah. Good evening, everybody. Sorry, I also am traveling, so I literally pulled off the road to just do this quick introduction, but I'm glad to be joining this evening. John Montero. I'm based here in Frisco, Texas, just north of Dallas. Been in real estate for 25 plus years since moving to Frisco in 2009. Have been really focusing most of my time and attention towards multifamily. So with my partners and my investors, we're over 10,000 units in Texas and also just broke into North Carolina as well. We also developed new development ground up projects in Texas in the multifamily space. So we've got about 2,130 doors in the development process, and just happy to be here. I've known about Jake and Gino for a long time, but never actually personally met. So exciting to be on and listen to what they have to share.
John
With that,
Montero,
I'll pass it over.
Is this the
Yeah.
same John Montero that's doing 500-pound deadlifts on Facebook, saying the post little pictures?
Not quite, but yeah,
He's at 600 pounds now.
Dude, I was like, wow. And he's saying he's 55 years old. He's got, I'm like, this guy is ripped, bro.
Wait, is this Liver King? You guys know about the Liver King? No, I feel like I'm not connecting right now. All right, look up Liver King when you get a chance. You got who? So
I was like, dude, that's awesome, bro. Keep rocking.
I'll hand it over to Ronnie.
Thanks, John. My name is Ronnie Phillip with the Kingland Group. We're a real estate private equity firm based in Dallas, Texas. We focus on Class A and Class B multifamily across the Sunbelt region. Bought and sold 570 units, and really excited to have Jake and Gino on. Really excited to hear their insights on what's going on in the current market. And I'll hand it over to Anton.
Hi, everyone. Anton Madley with Peak Financing. We arrange financing for commercial real estate, including obviously multifamily, which makes up a big piece of our business. I personally have been involved in commercial real estate for now 30 years. As an investor, we have done ground up developments. I've gone one of the few that has gone through multiple cycles. So what we see here is actually not really any dip by comparison, and thinking that this is now just over, I think is a little bit premature. I think we will see a little bit more opportunities down the road. Before I pass it on to Jake and Gino, and also definitely look forward to hear from you guys. Just wanted to respond to that question quickly. That'd be the Dwight, I think his name is, with the question, how would you adjust your cap rate, exit cap rate to a 1% interest raise? Reality is we already have seen that interest 1% plus actually an interest raise both on the fixed rate as well as on the bridge loan side. But it's important to look back to what has happened last time in 2008, 9, and 10. Everyone is always thinking multifamily just went through with flying colors. This is just not true, right? We have had a pretty significant price reduction, value reduction in multifamily during that time. And cap rates went up while interest rates came down at that time. So don't think about that these just correlate all the times. As Ferris has said, it depends a lot. And obviously it depends on investor demand, liquidity in the market, and it depends on what is available in the financing markets. So with that said, Ferris, do you want to start out now?
Yeah, I will go ahead. Thank you, Anton. Always a source of knowledge. So if you got that questions, Anton will happy to sit down with you for hours and hours and hours about that. That said, Jake, Gino, like I said, I personally wanted to make sure I was on here to just get to introduce you guys. Gino, for those that don't know, Jake and Gino have their own platform they put together for many years. I've listened to them, seen them, and, I've gotten to know Gino over the years. He's, a very good, genuine guy and a friend, and they do a big, diverse set of things. Jake, I don't know you well enough yet, but I am looking up Liver King. We'll have to talk about that here soon. I did look up some of the pictures.
Dude, it's serious, man. Liver King is no joke. So.
I'm looking at his pictures right now. But
I'm not trying to get too crude, but I think he eats like moose balls, guys. It's kind of crazy. So it's something you should definitely check out. So,
man, the results show it. So I'll have to consider that diet. But for those that know, Jake and Gino, large platform. They've been doing this for many years. Have a big, diverse. I'd like to say, every time I talk to Gino, there's something different going on. Right now, they're looking at land. Just kind of done a big, diverse set of real estate and have been around the block many times. And so figured it'd be very valuable to have people hop on and kind of listen to them. And they're both both sharp and entertaining people. So Jake, Gino, I will go ahead and hand it over to you guys. Anton will moderate because I do have to hop off, but you guys are in good hands. And for those that don't know, typically we do, 30, 45-minute presentation and Q&A. And then at the end, we do breakout rooms. We'll break out the audience into smaller groups. And so for those that stick around, hopefully you'll get a small kind of setting. Maybe you get Jake and Gino if they can stick around as well. So with that said, thank you guys very much for taking some time out of your evening. and I'll go ahead and head over to you guys.
Absolutely. Before Jake jumps on and starts, I just wanted to respond to what Anton said about 2008. I think one difference between 2008 and now is the demographics. I think we've become a much bigger renter nation, and I think the demand for renting is a lot more than it was 15 years ago. And I think the demographics of the age of the population moving down to the Southeast and the Midwest, that's why everyone's talking about being really hypersensitive what market it is. I mean, Florida 15 years ago is not what Florida is now. And millennials are starting families later, so they're buying homes later. There's not a supply of homes right now, so people are continuing to need to rent. So there's so many different things going on. It's really weird because you're trying to buy a home, but you can't buy one because prices are still going up because of the supply chain. And we're seeing people are trying to get out of our apartments, but they can't find anything, and rents keep going up. And it's just a really weird time to be around. We bought our first deal back in 2013. Rents for a one bedroom back then were $350, and they sucked. And the GDP was 1%, and it was just terrible. There was no money out there. You either have money or you have deals. Now it seems like there's a lot of money and the deals are less, but our rents for that first deal now are $995 plus rub. So you've seen cap rates compress, but you've seen NOI explode. So it's just one of those things that you can't really say it's going to be like 2008 because banks are really well capitalized, I think. And what happens when you give the banks money? I mean, Dr. Lindemann said this on our podcast. You give up banks all this money. What do banks do? They lend money to people who buy assets. That's why asset prices are continuing to rise, and there's still so much liquidity out there and so many people with so much money. And to get into even the family offices where they had like 5 or 6% of their assets in alternative, now they've got 15-18% of their assets in multifamily. So the demand is there. And I haven't heard anyone talk about crypto for the last 3 weeks because that's down 50%. So where are you putting your money? Our problem is we have people who want to sell their assets, but where are they going to put their money? They don't know where to put it because it's in multifamily right now. So where are they going to rotate it to? So we have to understand the supply and demand of where that capital is going. And I think investors have an appetite for multifamily because it is a basic human need. It's food, clothing, and apartments. But there is a basic human need. There's a bigger demand for it because more people want to rent. And then you bring in the aspect of people being transient in their workplace where they can, work for Stripe in California, but live in Austin and have that ability to go anywhere. I think that's really, really, it's just so different than it was 2008. I'm not saying we're not going through recession. I think we are, but I just think assets and the appetite and the fact that the money is still floating around in the banking system and all that, we just have to take that in consideration. That's why I think this may last for a couple more years before you have a little bit of pullback. So Jake, you want to rip it? Take it away, bro.
Let's do it. Now, excited to speak to, let's see, host disabled participant screen sharing. I was going to show some pretty pictures. If we can do that, I got this kind of little cadence here. We're going to go through it if we can. So,
Definitely
host.
can do that for you.
I'm looking for the power here.
And Anton's also host, but I will go ahead and
you got
make
the
you
power.
host.
No, I have the power, Gino.
Okay.
All right.
I give it to you, bro. You take it.
All right, cool. We got this. Oh man, I don't know now.
You spoke too soon, my friend.
Dude, the Zoom thing is messing with me.
Go to slideshow, bro.
I got it.
There you go. Yeah.
You know, what I was saying was I'm excited to, we're not the most tech guys here, but we're here, right? We can make some money on apartments. We're good at that at least. No, excited to speak to everybody tonight, especially because it's a group of syndicators. It's not necessarily our specialty. We've done some syndications, but really we just we love buying apartments and seeing the cash flow snowball build over time. It's kind of been our story from the beginning. I started off really looking at apartments in 2011. I met Gino. I was doing a lot of catering out of his restaurant in New York. I knew his brother quite well, and I was a pharmaceutical rep at the time, just looking for something else because the Sunshine Act hit, and ultimately it changed the culture of the pharmaceutical world. When I first got in, I was getting out of college. I thought I kind of won the lotto. It was expense account, company car. I was making 6 figures. Wow, this is great, man. I really hit it. And the culture was fun. I was, a previous athlete. It was competitive. It was a bunch of guys working hard to make money. And then the regulations just kind of went nuts and it wasn't fun any longer. So I was kind of looking at my life at the time saying I'm reevaluating things, and ultimately started state shopping. What do I mean by that? I literally ranked all the states in the country because I wanted to get out of New York. I was kind of sick of the bureaucracy, sick of the taxes. and did this ranking where I looked at state income taxes, I looked at weather, I looked at property taxes, and just overall quality of life. And I took a leave from New York to Knoxville, looked at Florida, looked at Texas at the time. This just kind of worked for me. So that's how we ended up in the Southeast. It was probably one of the best moves that I made. And I always say this to everybody. I think that you should look at your state and where you live, similar to how you look at the grocery store, how you look at the market. You go, you're price sensitive, you see the value that they're going to give you, and you shop it. And so many times people get stuck. Well, I got this, here, my family, this, that, and the other thing. And, I joke about it with Gino. It's like, I like Whole Foods. I'll go to Whole Foods every once in a while, kind of like I'm in New York right now, but I'm not going to live there, right? It just doesn't, completely line with my values and whatnot. So got out of New York, got in the Southeast, started looking at apartments the minute I got there with Gino. Gino had experience. He was mentoring me as we were going. And it took us 2 years to get in that first deal. We didn't have any credibility. Brokers were not taking us seriously. The whole thing, all the things that people look at multifamily and they see this pie in the sky and they say to themselves, well, I want to do this, but it's not for me. It's for the big guys. And that's why I'm excited to speak to each one of you tonight, because you're syndicating deals. You're looking at these larger deals. And the thing that I struggle with syndication, and don't get me wrong, I love syndication. We've done really well on our syndications, is that I think a lot of times it almost forces you to sell. One of the biggest mistakes that we made in our syndications is that we didn't put enough of our own capital in, because then I'm looking at it and I'm saying, okay, this asset just doubled in value. Let's refi, let's take some cash off the table. Let's not kill the golden goose. Let's keep this baby internally and let it keep riding, because as all of you know here, these things are not always easy to find. A really, truly amazing deal, we may see 2 of them a year that we really love. Why kill the golden goose? So that's some of the things we're going to talk about a little bit here, but ultimately, kind of hit the ground running with the GDAD in 2011, haven't looked back. So that's a little bit about us. Gino, you want to add anything to that?
Yeah, I mean, first thing I like to say is I taught Jake everything he knows.
It's true. Everything. I even homeschool now. I'm like a mirror image of this guy. Okay.
I've got 6 kids. We homeschool the kids. And for me, we were on a Bigger Pockets podcast recording last week. So it's our 3rd podcast. So it was really, an honor and privilege to be on that show for the 3rd time. And it's been an amazing journey. What David Green actually said to us, he's like, you guys are still partners? You guys haven't blown up the relationship yet? And for everybody here who's got, syndication partners, who has other partners, every time you go into a deal or a partnership, I really want you to think about what your values are and if they really align with the person that you're trying to work with. We call it values-based decision-making. I mean, Rick Zappi was one of our partners. He taught us that term. And I was just doing it subconsciously. And when I partnered with Jake and I met Jake, I was the pizza guy. He was the drug rep. He came into the restaurant prepared. He was a hard worker. He was professional. He showed up and he was ready to go. And I said, that's what I want in a partner. And for me to be able to grow this portfolio over the last 7-8 years and to be able to grow the Jake and Gino platform, it's because I have a partner like that who's holding me accountable. I mean, how many partners out there are going to show up at 8:30 at their dad's dinner table to do a webinar when he's got other things? Not many, but I can rely on him and he can rely on me. And that's what partnership is all about. It's very hard to grow multiple businesses without having partners. So what I would say is choose a partner that you're going to like to work with. I've spoken to Jake like 4 times already today. Choose a partner that you can really rely upon, but also you need to be stepping up for your partner as well. So I've been blessed for the last, 10 years to be doing deals with him. And one other thing, it took us 18 months to find that first deal. But after that first deal, it was 3 months for the second one, then 6 months for the third one. And there was momentum. I wish I had the Jake and Gino community when I started. That's the reason why I started the Jake and Gino community. We started out with all of these different, things that we're teaching students. I didn't have that going on. I didn't have the community. And this is what you guys have here. I didn't have the accountability. All I had was Jake, and I had an amazing wife. That was my accountability. And as we started growing and started doing podcasts and interviewing all these different celebrities on here and different coaches that we're talking to, that is what's really led to our growth and to our expansion. So when you're out there looking for partners, just think of people who you really want to work with and who you align with your values. We're not shiny object syndromes. We are not get-there-itis guys. We are here for the long term. We're in multifamily and we want to buy these assets and we want to hold them long term. And for us, I think the slogan is, you know, rich people sell and wealthy people hold. That's what our goal is, to continue to create wealth, and not only wealth for ourselves, but legacy wealth for our children, but also legacy skills to pass that on to our children. I want to teach my children all of these things, and I want to really work on their mindset, because money really is emotional. It's 80% psychological and 20% mechanical. If I can teach my children that, and I can teach the Jake and Gino community that it really is a psychological game, and you really got to stick into it, and having a partner who's going to have your back really just elevates your game and gives you the confidence to continue along the journey.
Well said, sir.
Thank you, bro. What do we got here next?
You know, I'm trying. There we go. Again, not the most tech savvy guys, but we can buy a deal.
So this is what we do. We put content out. We've got 4 different shows here. So if you haven't heard the Jake and Gino show, it's there. We're selling whole life insurance. I love the whole life space. 100-year real estate investor. My wife and myself, we do a show called the Julie and Gino Show. For all of you out there who have spouses, who want to work with your spouses, who have children, what I've learned is it's a battle on that podcast, because I love to talk about business and she talks about family. But ironically, if you're running a family and you're running a business, it's the same thing. I mean, same core values, same mission statement, same culture. That's what you're trying to create in a family and in a business. So we battle on that. And these are all the different publications we've created. We've actually launched 2 kids books over the last 6 months, The Cannolis Exploded and A Gelato Blast. So we're out there creating content, and it's just a lot of fun, just staying top of mind and really doing all the research. And one thing that the community has allowed me to do is it's allowed me to become a much better investor. I've learned so much going to different events and speaking to other high-level investors.
So 8 seasons of podcasts, 4 shows, 8 books, but we can't work a damn Zoom call yet. What gives here, man? We must have a good team behind us. That's the only thing I can figure
We
out.
really do. What do we do? We're vertically integrated. We've got 1,900 units that we've invested in. We've got $175 million in assets under management. We have 60 full-time team members. And the great thing about this is we've been able to refinance over $25 million from our portfolio and put it back into the deals. And most of these units that we have are self-owned. We've only got 1 syndication left. So the vast majority of these assets, they're owned by me, Jake, another partner, and a couple of, employees. So our focus is the small giants mentality. When we figured out about a year ago that we just want to buy deals. We want to hold deals long-term. We want to control them. And it doesn't matter the size, but we just like to have that small giants. If anyone's read the book, or we've done a podcast with a gentleman named Paul Spiegelman and even Bo Burlingham, the book is Small Giants. It really, if you want to talk about it, Jake, it really gave us clarity on what our picture was and what we wanted to really end up with at the end of the day.
Yeah, I think we can talk about that right now. It's, there's been times where we've hopped, markets. So we have a vertically integrated team, as it shows here. We have 60 full-time team members, in-house property management, in-house renovations. We sort of do everything, and that's what we like to do. We've just added development. Gino touched on, we're sitting on about 130 acres right now in East Tennessee. And, since the beginning, we started buying the scattered site. We started off with a 25 unit. We went to a 36 unit, and then we went up to 136 units. And we have 8 districts now. And ultimately what we discovered is we're great buying a 150 unit deal and then maybe a 50 unit next door, combining those with the same management group, finding efficiencies, and just doing really well from a cash flow standpoint. And so when we started syndicating, ultimately it messed with me a little bit, because we're taking the money, we didn't necessarily need it. And then, we're kind of giving away all that value. And I think one really good deal can change your life. It can literally set you free. You do a good 150 unit deal with you and your partner, or you and a couple buddies, whatever. That deal can literally set you free on the path to buying more if you don't go buy the Lambos and all that stuff in the beginning. You refi the money out when you're ready, redeploy it into the next deal. And that's really what we've done up to this point. And then what we started seeing is we have these amazing team members on, and they're seeing all this stuff happen. And we're saying, we have no problem letting them invest into our deals dollar for dollar. Okay. It might be 10% of the deal, it might be 5%, whatever the case may be, but we're letting the team members on now. And then, so in a time where, look, it's really hard to retain the A players, our folks are invested in the deals. They have ownership. And so we saw a path that we said to ourselves, we can kind of go this direction and syndicate when needed. So if a $30, $40 million deal comes our way and we need to, fill the gap 25% on the raise, we could bring in a strategic partner there, syndicate in that aspect, but no more of this sort of like, for us, we're going to go out and say, okay, we're going to get 50 people to pitch in $50,000. That sort of gets, a little bit labor intensive, and that is its own business in itself. So essentially, we're looking to kind of have our cake and eat it too, where if we need a gap or a fill on a large amount for a deal, we're open to doing that. It's just different from, some of the syndications that we did 2018, 2019, where we may bring on, 50 investors or something like that. So
it is music to our ears when you hear a property manager who's invested in your deal say to you, we need to raise rents. And this has to happen, because all of a sudden they have ownership.
But why, Gino? Get to that a little bit, because I think that that's the important point, is we've gotten pushback before, right?
Yes. And Jake's strength really is nailing the market with rents. He knows where rents should go. And, obviously property managers at some point, it's a harder thing to do, to raise rents. But when they own 1%, 2%, or 3% of the deal and they've refied their money out, they understand it's all about NOI. Obviously, we're still trying to deliver superior service. But when they see that they have that ownership, and rents go up, and all of a sudden they're getting a bigger draw, it just clicks for them. The maintenance tech's the same thing. We had a maintenance tech who invested $6,000 with us about a year and a half ago. He got a refi check of $18,000. His wife was hemming and hawing in the beginning. Why did you put in $6,000? And then when they got the refi out, she said to him, why didn't you put more? So you can't win, you know what I'm saying? But for him, it was life changing. And every time he goes and does work on the properties, he has a different outlook, because now he owns part of these deals. And it's just been, for us, it's been great. They have to be on board with us for 2 years, the employees, but it really does ownership. And I love it on the Jake and Gino side as well, because we're selling mentorship, and I want everybody on that team to understand and to really value and love. If you're selling a BMW, you better be driving a BMW. We're selling multifamily. Our employees are invested in multifamily, and they believe in that asset wholeheartedly.
Yeah, it's just ironic though, because literally in the past we've gotten pushback from property managers. Oh, single moms are here, we can't raise the rent. This, like, all the things that are real and a part of life, but at the same time, gas has doubled, everything has gone up dramatically. We have to stay current. And it's funny that the deals that they're invested in, they're like, yeah, let's drop the hammer, let's go. And the legacy deals, they're like, well, I'm like, no, I see what you're doing there. And so that you got to be very careful. But it's been eye-opening for them, and it's really been a game changer. So great point,
Love that, bro. And the community for Jake and Gino, the students right now, they're up to over 45,000 units closed. That's probably a higher number. I just can't keep track of it. The deal volume is over $2 billion, and, over 55 students have left their W-2 jobs, over the last 5 years. It's just like everything else. Once the momentum starts going, students start closing deals, they start working together. It's just something really amazing to see. And for me, this is one of my whys. When I got down to Jacksonville, I was going to start buying deals here 5 years ago. Everyone said the market was crazy. So I put the pause on it. I said, Jake, what do I do? You're in Knoxville doing this property management full time. You don't really need my help. I'm in Florida. What do I do? So Jake says, let's finish writing the book and start the Jake and Gino community. And 5 years later, this is where we are. So it's been an amazing ride for us. And like I said, it's made us much better investors by learning from our students and by getting the students together. And, selfishly enough, it's gotten me through COVID for the past 2 years. We've done our events, we've had students get together, and just the energy, the excitement, and the accountability to go to these events has really been life-changing for me and for my family, because my family comes to all the events. They come and hang out, they sell swag. And for me, it's just been a testament to them to see what, the entrepreneurial life can be and how you can create impact in other people's lives. And for them to see that, to me, has been awesome. It's been really great.
Well, and the really cool thing too is, like, we have a very strong internal management team. Our entire management team has gone through EOS. They've gone through scaling up. We've spent hundreds of thousands of dollars on systems training. And so all of our employees have gotten that training, and then they're able to do like a manage right boot camp and teach the management to the people in the community that come in. And I think that's been a tremendous value add that you don't see in the space, because I think so many folks are out there teaching like, oh, this is how you buy it. This is how you syndicate the deal. So we're actually showing the folks after, we teach that this is actually how you run a profitable business. And I don't give a shit about accrual-based accounting. It's about cash money. It's about your draw report every month and how much money you're putting in your pocket. And that's what we really drill down on our management side. Profit per unit every month. You got to know it. Okay. You got to nail your cash draw reports. And that's some of the stuff that gets pulled through that I think, interestingly enough, we were doing a prezo a few weeks ago, and we're like, let's talk about draw reports. Let's talk about the end of the month and things. And I got some blank stares. And I'm like, guys, this is what it's about. It's about the cash management. This is a business. This is not a fun little investment that you're doing on the side. So That's some of the stuff that we really try to pound
And Jake,
drive home.
to really finish with that thought process, I mean, at Jake and Gino, we say we create multifamily entrepreneurs, because I think that's the beauty, Anton would probably say it, about multifamily. You're creating a business. I mean, you're trying to scale up. And if you're the mom and pop, like at Jake and Gino at the beginning, a 25 unit and the 36 unit, 60 units, you don't need those systems, but that's where you start. You're going to start with that, but you have to start with the end in mind. And, you know, it took us 600 units to get Appfolio, and we've made so many mistakes along the way. But once we started scaling up, you need to learn how to become an entrepreneur. And that's part of the journey, whether it's, you know, doing quarterly reports, EOS, like Jake said, we did scaling up. A lot of the stuff we learned and we're able to teach our students. And it's really empowering to see people buy deals and look at real estate, not just as from a landlord, you know, tenant perspective, but from an asset management perspective. You're buying small, each one of these deals is a small business. And if you can start treating that like that, your mindset changes. And then all of a sudden you're buying these things for the long term, and you're implementing systems, and you're doing more higher level tasks. Jake is not editing podcasts anymore. Gino's not doing the bookkeeping anymore. I mean, we did that for so many years. It takes a little bit of time, you know, you got to work on it. But once you start seeing that and you make that shift that you want to become that entrepreneur and you want to become that asset manager, man, everything starts changing in real estate, especially multifamily, with the ability to scale up.
Well, and even that first unit, that 25 unit, that first deal we did, C minus. I'm giving us like the benefit of the doubt, right?
The Shamrock Hotel.
We still own it, and it pays us $6K a month after we've already refied all our cash out. Okay, I think 1 or 2 refis on that one, Gino. I don't even know at this point.
We did 1 refi, and the thing is we have a seller finance note on it. There's $500,000 first on it, and the deal's worth $2.5 million right now. Most people would have sold out of it and just crystallized the equity. We just refinanced it. And that one deal, which is ironic, it's between $8,000 and $9,000 a month on average. And that one deal, I always explain multifamily, the power to my wife. Us as the middle class, I was taught to save for an event. I'm going to save for college. I've got 6 kids going to college. I'm saving for my retirement. I'm saving for 6 weddings. When in fact, what I did was I bought an asset. You know, so you save to buy the asset, and that asset pays for the event. And that's what that asset is doing. My first daughter's finished with college. She's a missionary right now up in Tiger, Georgia. My second son, he's a sophomore. That crappy little 25 unit property put her through college. Now the second one's going through college on that asset. And you know what? All 6 of them are going to go with that one asset. Principal's getting paid down. It's appreciating in value. I've got the cost tag on that thing, and it's just an amazing, eye-opening experience. I was always been trying to explain to my wife the power of multifamily, and she says, I get it. You save your money to buy for that asset, and that asset will pay for those life events.
That's direct cash flow. Absolutely.
Mm-hmm.
So I think this is important. There's a few things here in terms of why we're doing this. Me as you know, I'm trying to phrase this as nicely as possible. I have a hard time with people telling me what to do or asking me to do things. You know, I think, no, like a hard D on the Myers-Briggs, you know, if anyone has gone through that stuff. So, you know, this gives me a chance to live a fulfilling life where I'm not miserable. And I think so many of us, you know, whether we're engineers or sales reps or whatever kind of, you know, job we get stuck in, if we have that entrepreneurial spirit, we know that inside we feel the shackles. And multifamily and being an entrepreneur has allowed me to live a fulfilled life and an existence where I can breathe and I'm not feeling suffocated. So that's one of the main reasons why we do this. But in addition to that, we're playing a game with no limits. You know, it's odd. You know, I'm kind of reminiscing because I'm home and you have friends around everything that are W-2 employees, and they're doing well. You know, 6 figures and whatever, but they're playing a different game. They don't have the ability to make millions of dollars every year because the job doesn't allow for that. And sometimes I feel like they're scratching their head saying, like, how did you know, go and do this and build, you know, a company worth $175 million, you know, in a short period of time? And it's just, we're playing a different game. It's not, you know, you can say it's not fair or whatever, but it's a choice that was made consciously to give myself an opportunity to not have a ceiling. So that's a big part of what we do. And I want to be able to live a life with abundance with my family. So that's where this basically all came from. Early on, it was, hey, let's try to get some additional cash flow. But it's really cool though, because now I have a very strong partnership with Gino, know his family, you know, extremely well. And the great thing is that whenever we do a really good deal, now I have almost an extended family with his family, and we're bringing, you know, the whole cruise lifestyle up. So it's pretty amazing for us, and it's been a great ride.
Jake, do you mind if I just mention one other thing on this?
Yeah.
I guess on this slide, what I'd like to say to everybody is, I'd like to hear why everyone on this call is utilizing multifamily as a vehicle. For me, just think about, start with the end in mind. I think just put in the chat box, well, why are you doing this? For freedom, for financial freedom. What does that look like? I'm doing this for retirement, whatever that is. I love to hear from everybody out there. For me, it was, I wanted to be a good role model for my kids. I was going to work at the restaurant. I was miserable. I hated it. I came home working hard. I didn't want my children to equate hard work with not liking your job. And I really wanted to find fulfillment in my job. And when I quote unquote became financially free from the real estate, that's what allowed me to really start Jake and Gino and really create that impact for others. And Tony Robbins talks about the 6 human needs. I was barely doing 1 through 4, the basics. And then once I got into real estate and multifamily, I really started with that contribution. I always had contribution in my life, but it was very hard when you're working, that W-2 job and you're paying bills and you're focusing on yourself. Once I became financially free, I was able to chase opportunity, not only just chase money, but looking at opportunity, looking at different ventures, looking at different businesses. And that's what I think multifamily has allowed me to do, that contribution and that growth. You got to continue to grow. And I love the fact that we're always looking at deals. We're always learning. We're always on these calls and always doing these podcasts, because for me, if I'm not growing, I'm dying. So those are a couple of reasons why I'm doing it. But with everyone there, just start with your end in mind. What do you want multifamily specifically to do for you? It's important.
Yeah, and here's the deal. If you just want money in the right market, like I'm not buying deals in New York, but in the right market, it's just damn good business. At the end of the day, the tax benefits are amazing. Okay. You get a cash flowing deal in a right growth market. It's just damn good business. So I don't think you can deny that.
Jake, I got to respond to Amber. I think Amber, same thing with me. I want to make my mom proud. I give a quick story. My mom was just killing me about, we got to stay small. We're a family business. We can't expand. It's 2008.
This is Gino at the restaurant, just for the folks to give them a backstory.
And this is me at the restaurant, because I was in business with my mom for years. We did great in the first 15 years. 2011 comes around. I started investing with Jake. I did not tell my mother until I had 200 units that I was partnered with Jake. And at the 200 unit level, I go to my mom and I say, Mom, by the way, I'm leaving the restaurant in 6 months. She was completely floored. She had no idea. It's just one of those things where every time she saw me working, she'd always say, you're working too hard, take it easy. And it's one of those things I just didn't want to do. But in my back of my mind, I wanted to make my mom proud, to see that I could really become this amazing entrepreneur. And that's what drove me. I was moving away from pain. And that was my journey starting out. Sometimes you have to move away from pain. That's what really, really focused on my life. And now my life is more moving towards pleasure. So thanks for all the answers, because I mean, it really means a lot. And that's, Simon Sinek always talks about it. What is your why? You really have to lean into it sometimes, because this is a tough business. Any business is a tough business. My partner, 2-3 weeks ago, we just completed a refi. Over $1 million in this refinance. We had several partners on this thing. And I said to him, bro, thanks. You crushed it on this refi. Thanks for giving me this money. I mean, you just gave me more money than I ever made in the restaurant in a year. I said, did anyone say, I'll say thank you to you? And he's like, nope, you're the only one. So if you're doing this for thanks or for anything else, good luck, because as an entrepreneur, it can be a lonely journey. That's why having an amazing partner really helps out for me. But you're not doing this for accolades. For me, I'm so clear on why I'm doing this. I'm doing this for my family, and I'm doing it for my partner, because I'm putting food on my partner's plate and he's putting food on my plate. So just really be clear on why you're, in multifamily or any venture or any business.
So Gino, I'll give you a little backstory. So my daughter, Emma, Gino told this story about hiding from his mom and not telling her about the multifamily early on. My daughter was going, was Gino doing something wrong? Why wasn't he telling his mom about this? I'm like, no, honey, he wasn't in a good spot, because moms can be very protective at times and they don't want their sons to fail. So I had to have this whole talk with her about how you weren't doing anything wrong. You don't want to hide stuff from mommy, but it's okay, because he was doing it, to not scare his mom at the time, because he was doing the right thing. So it was ultimately a challenging conversation, Gino. So thank you for that.
Jake, a man with money meets a man with experience. The man with the experience gets the money, and the man with the money gets the experience. I don't know if anybody's that's ever happened to. On my first deal, lost a ton of money. And my mom to this day has not allowed me to forget that I lost $172,000 on my first mobile home park. But you know what? I've made that back 100-fold. So I try to remind her that let it go, let it go, let it go. She just doesn't want to let it go. So every time I would talk about a venture, she would go back to that. And it's just like, at some point we have to let go. It was a great learning experience for me. The part that was terrible, it really was his fault. But ultimately what it taught me was responsibility. I need to be responsible because I didn't do due diligence. Did I go fly down and look at the deal? Did I vet my partner out? No, I just gave him money. And that's what happens. He got the money, I got the experience. And that's a really big learning lesson. Our values weren't aligned. When I met Jake, I'm like, ding, 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 values aligned. I can work with this guy, hard worker. So it was been, gnawing at me all these years. And she mentioned it last week, 2 weeks ago. Yeah, I'm like, we're losing their money everywhere. I'm like, Mom,
she mentioned to you 2 weeks ago. Dude, this is like over 10 years ago.
Yes, it's like she's like, we're losing money everywhere. I'm like, what are you talking about, Mom? Because she's worried about the recession and she's on the news all the time. I'm like, it'll be okay. No. It'll be okay. So, yes, a lot of energy behind that. But for me, Amber, it really, really did stick out to me that was my driving force. I wanted my mom to be proud of me and say, and now she's coming to MM4, all our different, events, and she's finding out what I'm doing. We're speaking on stages with thousands of people. And she's like, I can't believe you're doing that. So sometimes you just have to surround yourself with the right peer group. I mean, I didn't have the right peer group 15 years ago. Now I've got the right peer group. Jim Broom says, average of 5 people. I mean, I've got 5 amazing people around me, and that's what's allowed me to continue to grow and continue to grow.
Wonderful. So, gang, ultimately our goal tonight is just share the stuff that's worked for us. We've had a really nice, last 10 years in the multifamily space. It's changed my life forever, ultimately. And we just want to share some of the things that have worked well for us, and hopefully you can apply them to your life and your business, and hopefully get some value out of this. That's ultimately our goal for this evening, and nothing more, nothing less. So our first book, I want to talk a little bit about this, Wheelbarrow Profits. Again, I was in pharmaceutical sales. Gino was in a restaurant. We don't think that multifamily investing is rocket science. We really don't. I joke with our team right now because, we have, folks on our team, underwriting the deals for us and showing us like elaborate presentation. Here's the IRR, all this great stuff that we're going to get over time. And sometimes I got to dumb it down for the team and say, guys, we're not making money on this thing from day one. We know that the rents are suppressed, but we know where we can get them. We're buying boxes, and we're going to get to what that looks like in a little bit. So that's a lot of what we do right now. And we want to be clear on that. Use a lot of loan to cost, kind of use community banks for bridge right now. Ultimately, we can get to that in a little bit. But really what we found early on, and this is where we came up with our 3-legged framework: buy right, manage right, and finance right. That's how we view multifamily. It's really what it comes down to. And for myself, I like frameworks so I can put the framework in place, and then I can check myself as I go to ensure that the system is working, okay? My ultimate goal is to build an enduring organization that is a well-oiled machine. Very simple, okay? But the actual work that goes into it is not. That clarity will set you free, though. So let's look at it. You buy the deal, hopefully you buy it right. You know your parameters, you buy right parameters. You finance it. If you're us financing, we weren't the ones doing the floaters over the last few years. I had a deal that we did, I think in 2016, 149 units. We had 4.5% debt on it. People are like, what are you doing? You put 15 years, 4.5% debt on it. Right now, okay, everything seems hunky-dory and it's fine. And it cash flowed good then, it cash flows good now. I'm looking for long-term fixed rate financing, so the interest rate risk is off the table. What am I doing here? It's process of elimination, okay? The buy right comes off once you buy it. Financing for the long term comes off. The last lever that you got, and I think a lot of people ignore this, is that manage right. Do you have the proper systems? Do you have the proper KPIs that you're going to be able to run an organization tight? Everybody on this call right now that's an asset manager, I hope you're getting on with your property managers if you're doing third party at least once a week and driving the ship. You can't leave the property manager to be the leader. You need to be the leader dictating what happens on those properties, not the property manager. And we see that as a huge fault many times, especially people getting into syndication early on. You need to be the leader. You need to drive the ship. So talked about that a little bit, but let's focus on the buy right part, because ultimately, when you're buying one of these deals, to process deals quickly and get the bullshit off your desk, we believe you need to have the right parameters in place. And having proper buy right parameters is going to allow you to build better rapport with brokers and see more deals and not waste time if you do not have a big team. I know there's some folks on this call right now that have probably a bunch of people underwriting for them, and they've really scaled an organization. If that's not you yet, you need to find hacks. And I think one of the best ways to do it is to set your parameters. What vintage are you willing to accept? What market is it going to be in? Okay. What are your cash flow parameters? What are you looking for from an IRR perspective? On and on and on. So I think we're going to get into that a little bit. I want everyone to get clear, and I would love right now to get some interaction with everybody. Share with us your buy right parameters in the chat. What are you looking for in terms of vintage? Is there certain median income that you're targeting? Let's get interactive with it a little bit, because I think that'll make for some great discussion to see the differences in what everybody's looking for. And I think a lot of times when you're looking into a market, you're looking at that median income, a lot of times there'll be a correlation with crime. Be like, oh, no shit, right? Ding, ding, ding. But you get in that, $50,000, $40,000, $30,000 median income track, you're probably going to see more crime. So that's a good, predictor of that as well.
Jake, let me jump in real quick here. I think as you guys are thinking about your buyer criteria, we've also talked about something called the 3 pillars of real estate, and we've trademarked that. And these concepts are all out there, but the 3 pillars, if you guys want to write them down, the first one is market cycle. The second one is debt. And the third one is exit strategy. And Jake and I, when we first started out, we didn't know anything about these 3 pillars, putting them together. And the reason why is that exit strategy is so important. That's where most beginning investors make mistakes. And, one of our coaches, Bill Ham, he's a pilot. He says, hey, takeoffs are, optional. Landings are mandatory. When that plane comes off the ground, you have to land that baby. When you buy that asset, you have to exit that asset at one time in your life, whether you're refining the asset, whether you're selling the asset, or you're going to buy and hold this forever. So I think the first thing you need to do when you're underwriting or looking at a deal, are you comfortable buying that deal in that market for the long term, if that's what you're doing as far as your exit strategy? Or are you buying the deal for 3 years and flipping it out? Understand what the exit strategy is, because then you'll be able to couple the debt and complement it with the proper exit strategy. And I think the market cycle, the buy right criteria, your buy right criteria is going to change with what period of market cycle you're going to be in. When Jake and I started buying assets back in 2010, 2011, that was buyer's market. You're buying, C assets at, 25, 30 a door. You're buying those things by the truckload because you're going to put value add on those things, and they're going to appreciate in the market, and you're going to refi and roll much more in that part of the market cycle. Now we're looking at assets that are much newer with a lot of less capital expenditure requirements on it. We're looking at something called valuation through operation, not just renovation. We're looking at assets that really are the mom and pops that are out there, that are under rented, that have just terrible operations, that have no customer service. And that's where we're deriving value from. So for us, I love that, Pat, 1980 or newer, B or C, value add, Central North Carolina, 20 to 80 units. Love that. That's excellent. I'm going to have Jake jump on here and show him what other criteria there is for buy right, but really think about what your exit strategy is and try to couple that where you are in the market cycle. And like I said, right now, those 70s assets, not that we're not buying them, we just need to make sure that we're buying them right, and we're creating a proper budget for CapEx, because right now, stuff built in the 60s, they've got cast iron plumbing, they've got old roofs. You just need to make sure in your budget that you're allowed to really invest in that asset and make money with that asset.
So I said it. Pat is the only one showing some trust right now. We got some people on the fence. There's no trust within the group yet, and it's concerning. I don't know. We got to get some people. Pat, are you out there? See if we get Pat off mute here.
Hey, I'm here. Somebody has to have a beer and start answering these questions.
Dude, I appreciate the participation, man. So why the 1980s or newer? Just out of curiosity.
So North Carolina, usually cast iron, cut that out in the late 70s or early 80s. So it kind of made a strong decision there to not deal with cast iron. I've done it in single family, and it hurts the wallet when that stuff goes bad. Mm-hmm. Lead-based paint, obviously, one of those things just want to avoid. And I find that most value add is going to be in that 80s, late 80s asset.
Love that.
I think that's such a fan. I mean, think about it too. So you're getting plumbing advantages with the 80s. You're getting paint advantages, and probably a lot of times there's the potential for electrical pickups as well, because you're not getting those Federal Pacific, Zinsco type stuff in the 80s product most of the times. Possible, but many times you're avoiding it. So there's 3 huge pickups you're getting there by focusing on an 80s asset versus something prior to that. That's a fantastic.
But Jake and Pat, right now the market is changing, so you could go to older assets potentially the next 6 months, because you can possibly retrade.
Got it. Got
No,
the thing.
you could possibly retrade now. That evil word where you find Federal Pacific, you may be
Oh,
able to
man.
go back to the seller and
Dude,
say, "Hey, Mr.
Gino's gonna
Seller."
get blackballed on this call right now for bringing up the retrade. Look at the market gets a little shaken. He's already trying to retrade.
Dude,
man.
brokers are calling us back now. You know what I'm saying? Things are starting to change. Prices are starting to adjust downward. I'm just saying, like, that's what I'm saying. You really need to be on top of where the market is, where the brokers are, where pricing is going. 6 months ago, if you asked for a retrade or you said, I'm not going to, no, you have to pay for this asset the way it is. So each breaker is going to cost you $3,000. You've got aluminum wiring in there. Those things, you're going to assume them. But now the market going forward, you may be able to, get some concessions on that. So that's why it's really important to understand where your market cycle is in your specific market.
Why the 20 to 80 units, Pat?
So I've done two properties, taken two properties full cycle. They've both been under 20. And so just kind of slowly scaling as much as I'd love to get into the hundreds. There's just a lot of institutional capital right now. And I generally—
You're buying those in-house with your own cash, I'm guessing?
The first two I did. The next one I'm looking to syndicate in that 20 to 80. And, I want to involve people who trust me and know what I'm doing. And so a lot of times accredited investors got to earn that trust. So I do have a lot of non-accredited that are interested in investing with me.
Excellent.
Gotcha. Very cool. We got all right. So now we got Daniel, 1985 or newer, Class B or C value add, 5 to 100 units. So very, very similar there. Florida market. Very cool. Man, everyone's got hit the nail on the head. The 70s product's gonna be available, Gino. We can maybe scoop some of that up. There might be an opportunity there, right?
Well,
I'm seeing
market's going to shift, my friend. That's what it is. And it's great because, it's been tough with brokers. I mean, like, you've had to take it. Now the calls to offer, there's less calls being offered right now. I think assumptions are coming back as well, Jake. I mean, if you can have a loan that's assumable, that has a little bit of interest only left on it, a couple of years ago, they'd laugh at you. Now it's like, oh, wow, I've got a loan that's 3.5% with 2 years of IO left. There's some demand for that asset now also.
Angel just got a 72 unit across the board. Well done. Amazing. 15 minutes from her house, investing in the backyard.
That's awesome.
And then Tom's liking the big employers here. He wants schools and hospitals, and he's also okay with prisons. I'm not sure. Maybe he's looking for the prison guards, maybe, or is it, maybe he's just okay if someone escapes too. I don't know. We'll see what happens
Jake,
there.
what Pat said was important. This part of the market cycle, he was talking about the institutional capital. Our last 5 deals, we closed on a 25 unit, a 21 unit, an 18 unit, a 12 unit, and a 40 unit. Now we've got 60 units. These small assets in this part of the market cycle make a lot of sense because, like I said, like Pat mentioned, there's a lot of institutional capital. So these smaller deals, these scattered sites, private equity, they don't want to deal with these small assets because they're harder to manage. So for us, we're able to assume them into our other properties and get that scalability there. So that's where the big, I think, pickup for us has been in these smaller scattered sites, because there's a lot of mom and pops that are owning these. They don't know what they have. They've had rents at $600 for the last 4 years, and all of a sudden a 2-bedroom is not $600 anymore. 2 bedrooms, $1,100, $1,200. So there's the value there. So Pat, thanks for mentioning that. That's what we're looking for as well. A lot of these smaller assets in our market make a ton of sense.
And Zach, you want to elaborate a little bit on what you're saying? So Zach says to his investors, good deal, age is different depending on where and what we're buying. Zach, you want to elaborate on that a little bit?
So I'm in the Cincinnati MSA.
You got the bed bugs, right?
We're actually buying a set. Oh, well, we don't have them. We don't have too many of those anymore.
I thought Cincinnati was known for like the bed bug capital or something, man.
Yeah, at one point it was.
Okay.
But anyway, so we're buying right now we're buying a 17 unit built in 1900, and we're also buying a 2020 build in Cincinnati that only a couple years old. Some of it, like a 17 unit, you can see it from one of our other properties. It just a little scaling up, and then the 2020's got tax abatement. We were able to navigate the hair on that thing, able to make it work.
So what do you do with the 1900s building?
Raise like in a market like Cincinnati, it's like their walls are 3 feet thick. They don't move. You can refurbish them. People love that. They got 12-foot ceilings, and the guts are easy to replace. But this one's already pre-done.
Okay, so you're not going in and doing like I got you. I was wondering if you were kind of doing the initial work on it or something.
No. But
that's awesome, dude.
I mean, we're also I mean, in the Southeast, I just contracted one for 230 units, 70s for 45 a door. Needs a ton of work. So, yeah. So, kind of saying the age is all over the place. And then we bought the last one I personally closed was a 240 unit in Motion Springs for 140 doors, 2011 build that I picked up by messing around over at NMHC. So
nice,
just having a good talking to people. So
that's awesome.
Yeah.
Yeah. I mean,
Great
guys,
job.
and here's the thing: we're looking for similar stuff too, but we're not snobbing. I mean, like, we have stuff built in the '60s, and we do extremely well with it. It's brick. The roofs are brand new. They're pitched. You know, the central heat and air work has been done. You know, issues that happen with the plumbing, we take it as they come. Right? It's part of it. But the things cash flow very nicely, so it's not something that we, you know, are super aggressive on. But when the opportunity is there, we definitely snatch them up. So not afraid
Jake,
to go there either.
I love this slide because this is some of the buy right criteria. Is looking at the age, looking at the median income, unit mix. We love 2-bedroom townhomes. I mean, we love that. We love them with washer and dryer hookups right now. We like population growth, job growth, and really in the Southeast, that's where we're investing. We're investing within 3 hours of Knoxville. So that is our criteria. So when a deal pops up with our criteria, and as an investor, as an entrepreneur, you need to focus and be able to say yes quickly to an opportunity. That's why having those buy right criteria built out, understanding your market, and knowing your market really, really helps to be able to pull the trigger on these deals quickly.
Yeah, and knowing your market, like in our market, there's not many 3-bedroom apartments. It's just something that, you know, we understand from being in the market for a while. So a 3-bedroom, you know, complex came up. It was all 3 beds. We scooped it. We paid more than we normally would because we knew that there's going to be upside on it. So, you know, I think knowing your market when these things arise and really get in detail with it, it can make a huge difference. So, you know, just to share, you know, kind of what we're looking for. Love the 80s or newer. 50,000 median income. I personally love 2 beds. Love townhomes. We do really, really well with those. There's quite a few. You know, job growth has kind of been, you know, what it is. It's been there, and we've seen a lot of growth in, you know, just coming from the, you know, New York, you know, Michigan area, coming down to the Southeast. But for us, because we are vertically integrated, essentially we have our central offices in East Tennessee, and we look at about a 3-hour radius. We have, you know, assets in Lexington. We have stuff kind of that we're working on in Johnson City, trying to breaking through the Chattanooga market. So for us, it's expanding from that central nucleus out, and not, you know, leapfrogging, you know, say, you know, over to Charlotte just yet, because, you know, we probably have to do third party, and we're just kind of focused on that internal team building. And that's what's worked for us. Does it make it, you know, right or wrong? You're not going to grow as quickly like that. I think if, you know, the goal is to acquire as many units as humanly possible, our strategy is probably not the best, you know, just to be frank, but we do really well. We control costs, and we expand from the inside. So that's been our thing.
Ways to take out a deal.
Yeah, so this is what I wanted to, you know, get to a little bit, because I think so many of us, you know, especially on this call, are focused on the syndication, and it seems like, man, this is really where we want to be, guys. Again, love the syndication, but, you know, early on, and this may be something that's coming back, owner financing. We've owner finance. We did a 281 unit owner finance deal. You know, we got back $75,000 at the close. Master lease options, you know, are on the table. But ultimately, the joint venture has been great. You know, going in for, you know, ourselves, using our own capital, buying these deals, refining the capital out. That's worked really well for us. And now we're adding development to it. So I think having these different tools in your belt will make you relevant in any part of the cycle, because what's happening to us now is our thing is the mom and pop investor. We love going in, getting the larger mom and pops, kind of scooping those out and putting proper management in place. What we're seeing now in our market, there's about 5 really big ones left, and they're kind of holding on. And so we're having a hard time breaking through. So what do? Do we stop growing? Do we stop buying deals? Do we just start, like, you know, jumping across the country to get into these things? And are we going to run into the same sort of thing where the really, you know, screaming deals are gone? That's why now we're saying, okay, we have the vertical integration. We got our general contractor's license in-house. So now we're looking for land opportunities where we can actually develop some build for rent communities. Because remember what I touched on before, profit per unit. We look every month at our profit per unit, and we have some, I'll call them quasi build for rent communities. They're townhome developments that we purchased, upstairs, downstairs, 2 beds with a garage, washer, dryer hookup. So we want to model the communities that we develop after those. because even though they were some of the most expensive units that we purchased from a unit perspective, the price per unit was high, the profit per unit was even greater compared to some of our garden style. So that's why I really challenge everybody, when you're looking at your draw report every month, you have these different type of assets in there, what's making the most money? And sometimes it'll surprise you that sometimes the assets that you paid the most for over time will actually return the most. And that was something that I really struggled with early on. And, because we can still get caught up on price. What's the price per unit? A lot more to look at than just that. So that's where I really like to challenge everybody this evening.
Jake, Prasad asked the question, how are we funding our deals? Early on, and this is relevant right now because I think, someone mentioned this to me, that debt is the circulatory engine of the economy. And early on in 2015, we bought a few seller finance deals. I think seller financing is coming back right now. I think it's going to come back. And I've been waiting. We wrote the book Creative Cash with Bill Ham, and it's taken longer than what it has. But now you're getting the 6-7%. A lot of these deals can't be financed. You're going to have a lot of these mom and pops who have a lot of equity in the deal. So seller financing is definitely one way to start financing these deals. And the other way, like I said, we've been able to refi over $25 million from our portfolio. So it's the long game. So that money is not going out and buying. I don't own a Lambo. I've got one car, I've got 2 houses. That money just goes right back into the business. And that's what we've been able to do. I mean, you refi $500,000, it's a loan to yourself. So you're not paying taxes on that money. And that money just goes right back into, you have to be diligent. And it goes right back into your next deal. And that, if you have to, what we think of is we created this thought process of this strategy called a conveyor belt. Your goal is to put as many deals as you can on this imaginary conveyor belt. Year 1, putting a deal. Year 2, putting that deal. And then by year 3, that deal is matriculating. You can sell that deal and repurpose that deal into a bigger asset, or you can refi that deal and get that money out and repurpose that equity into another asset. It may take a couple of years to do that. It did for us as well, but that's what your goal is, to put as many assets on this conveyor belt as possible and let time and let NOI do its magic. And then right there, and for Jake and myself, was it a mistake to keep that 25 unit? A lot of investors would have cycled out because we're buying newer assets now. It's just one of those things that we bought it at such a good price point. There's really not much debt on it, and it's just working really well. But that asset could have been sold and taken that money and repurposed it and bought a newer asset in this part of the market cycle. So Prasad, those are really 2 ways that you can do that. And like I said, saving money. We blow up our 401ks. We don't diversify into any other asset class other than multifamily and businesses. So all our money is going into that. I think the stock market's the biggest joke on the planet. I think, when you start the 1970s 401k and you create demand for that. And now when you retire at 60 years old and you have $1 million there, you don't have $1 million. You have $600,000 or $650 or whatever the number may be. So for me, I don't deal with any of that stuff. My focus is strictly on multifamily and putting all of my money back into this, and what I would refer to as these businesses, these individual little cash machines.
I like that, cash machines. It's a very good way to put it.
You taught me that word.
What do you think about the MSIs, Gino?
So real quick, I mean, I want to put a little link in the chat box for MM5, but for us, and there's a lot of high level investors on this call, you start out with this 25 unit property. You're not thinking about the end game when you first start out, but Jake's got MSIs here. There are multiple streams of income. We started out with one property. And then from that one property, the second stream of revenue came by creating a property management company. And then at 200 units, we started Jake and Gino, which was the education company. That's the third stream of revenue. And then the fourth stream of revenue, we created a syndication company. And the syndication company had the asset management fees and the acquisition fees. And then we created a company called 100 Year, where we're selling whole life insurance. That is really an amazing tool. We call it the dual asset strategy. And from there, we have development. So from this one little crappy 25 unit property, we've been able to expand into, over 1,000 units, but add all of these different multiple streams of revenue. And what's important, everybody, is that
don't forget cable and laundry and all the other things that come along with the fee game as well. So it's
I love that. That's right. That's right. But they are all complementary to multifamily. I'm not going out and buying a pizzeria unless somebody is running the pizzeria for me and I can own the building. So for me, it's really focusing strictly on the asset of multifamily and building it out as far as having it complement that asset. So we didn't start out thinking this way. Yeah, we just actually like Jake said, we stayed in our lane. It was really, really important.
Yeah, and I think this is really important to think in decades. I'll share just some losses that we've had. We bought a deal, really nice, 2005 vintage. We got it really lucky on it. It was like 45 a door back in the day. All of a sudden, the market runs up a little bit. We think this guy is crazy. We sell it for $100K a door. We're fist bumping, man. We're Billy Badass. Aren't we the coolest guys in town? This is one of the biggest regrets that I have, because this deal is now worth $150 a door. And, we bought it ourselves, we bought it internally. And while we had a nice run up, I would rather own that asset today than have sold it.
Mm-hmm.
And the other thing is, I know we've all gone through challenges with property managers. And this is why we say think in decades. I'm going to give an example. We bought a deal in 2016. Another deal we paid just under $50,000 a door for is 156 units. Okay. Deal right out of the gates was doing really well. We had to make a change at property manager. Draws at the time were like 20,000 a month. All of a sudden they dropped down to like 15, 14, 12. And we're like looking at the property manager saying, look, we have a renovation budget. This is what we're willing to put into it. Stop over fixing the property. It wouldn't stop. Eventually had to fire that person. And it was hard too, because just a, really, smart, good property manager, but wouldn't follow the rules and was trying to do things and enforce more expense on the business than it had at the time. So I'm thinking to myself, okay, it ran up. I could exit now for 70 a door if I wanted to on this asset, put over 20 in my pocket per door. It'd be great. Didn't sell, fired the property manager. Then there's another inflection point where it went up to 100. Now the thing's worth 100. Now it's worth 130 a door. So I think what happens is we get these assets and there may be inflation, there may be market, things going on, people moving in, rents going up, this, that, and the other thing. If you think across a 10-year period, look, that's where your debt is going to be set. If you lock in for 10, you're going to have maybe a potential 2 bad years in there that may be related to poor management. There may be something else going on. Who knows what the thing is, but over that 10-year period, if you bought the deal right, you have proper systems in place for management, and you put good debt on it, over that 10-year period, you're probably going to be pretty damn happy that you bought the asset if you didn't overpay too much on the front end. So I challenge everybody to not to get too, trigger happy. Like we said in the beginning of this call, all these deals are starting to flood in. Why is that? These people, maybe they're not thinking long-term, whatever the case may be. Maybe they don't know how to manage right. Maybe that's an opportunity for everybody on this call. But I think for the folks on this call, do your best to think for the long-term. You're going to have management issues. Fix the issues and move on and get the property back on course if you did underwrite properly on the front end. That's the thing, because the one mistake that I did make was selling too soon. I wish I still had that asset now, but it is what it is. I learned from it. It was a hard lesson to take, even though we profited from it, but I would rather have it today. So.
Love that. I think we're going over, Jake. It's 9:45 already. I mean,
let me just hit this real quick. Sorry, guys, we get passionate about this. We're kind of losers. This all we do is talk about multifamily, so we can go a little long with it. But I will say this too. Look, it may not cash flow from day one. We talked about buying boxes. You may be, sitting there doing a loan to cost deal. You may be doing a bridge deal and waiting for it to get there. But if it don't cash flow, let the grass grow. We don't buy things for appreciation. If we're not going to see a cash money return going into our pockets every month in the future that we know we can achieve, we're not messing with it. So I really do think you need to buy the cash. What is the cash going to do for you? Don't want to play the appreciation game because rates could run, other factors could happen. If you don't think you can achieve the cash from a cash on cash perspective, I'm not touching it. That's my personal perspective.
And Jake, one last thing about that. And as we wrap up, I think right now in this part of the market cycle, we're buying basically on a pro forma. We're buying on our pro forma, what the asset can do within the next 12 to 18 months, because the rents are so suppressed that, like Jake was talking, we may have to buy these things on loan to cost with the community bank, but we'll refi it out in 12 months or 18 months. But that's what we're buying on. We're buying on a pro forma of what it can go up to in the next 12 to 18 months as far as rents are. And in our market, they've gone up 20% in the last year. Will they go up 20% in the next 12 months? Probably not. But some of these rents are so suppressed, buying deals for $600.
Let me talk about Sharps Ridge. Just give everybody an example. Bought this complex, literally emptied it. Okay, we bought it for $65 a door, put $15 a door into it. Okay, now the rents are $1,200. We're getting $1,200, $1,300 rents for it. At the time, the guy thought like we were nuts, but ultimately that's what it took. Buying boxes, we saw the opportunity, bought the boxes, put the money back into it, renovated the complex, and now it's paying off. At the time, there was zero money in it. Like it would make no sense to do it if you didn't put that value add component into it. We went heavy, but it was well worth it. So
there's a couple questions on here, Michael. And if you guys want to just email me questions, Gino@jakegino.com. I know we've gone a little too long.
yeah, sorry for going long tonight. Yeah.
I just love to do it. So one last thing, in that chat box, we have Multifamily Mastery 5. If anyone wants to come out to the financial vacation for smart people, as we like to say, we had 900 people last year. We're shooting for 1,200. So I'd love to have you guys out there. We're always looking for high level investors because it's a networking event. People are raising capital. They're doing deals at these events, and it's important to get out to these events. So just want to thank you for the privilege of, listening to Jake and myself talk about multifamily and just try to, educate you out there and try to limit your downside risk and put things in frameworks, the buy right, the manage right, the finance right, and the 3 pillars, and utilize that all for yourself to have you create your own personal business plan.
Yeah, and Multifamily Mastery 5, November 5th and 6th at the Gaylord Palms in Orlando. This is the only event that we do throughout the year that we open up to the general public. We do multiple boot camps throughout, but this is a multifamily conference based on teaching, and you're going to have really high level people there. We got Luke Wren, we got Ryan Serhant, who has a $100 million listing right now. Is going to be talking about building your brand, how to get out there as a syndicator. We got Julius Thomas. We just got some really, strong folks coming, and it's going to be really impactful. So, and we got our management team there teaching manage right too, which is my favorite part. So,
yeah. So really great nuggets there, guys. Really appreciate it. Don't worry that you ran over. Our participants here, they usually hang out even in the breakout rooms afterwards. So don't worry about that. Really, I think for obviously a big chunk of the audience are syndicators or want to be syndicators, but what you communicated here, I think, is some of these items are really important for everyone to remember, like the partnerships that you have mentioned. So many syndication partnerships do not work out in the long run because everyone jumps into them rather than evaluate
value-based decision making. Yes,
right. Yeah. Are the values aligned, right? And I think that's what you pointed out, right? Between both of you, the values were aligned. If they're not aligned, the partnership likely is not going to work out for too long.
Anton, let me ask you, do you think also for your investors as well, you've been doing it for years, as you become more experienced and you become a bigger syndicator, I think your values have to align with your investors as well. You really need to pick and choose. Do you want that person investing in your deal? Are they going to call you every week about what happened? Why is there a plumbing leak? Why isn't the draw this? So you have to really think about that as well. And you have to align yourself. If you want to be more of a buy and hold kind of investor and your investors want to be out in 24 months, is that going to align with what you're doing, or vice versa? I mean, you want to be out in 24 months, but you have investors that want to hold for the long term. So I think you have to look at it from that perspective as well. You want to be able to align with your partners, but also with your investors as well.
Yeah, absolutely. Right. And I think the majority of all the syndicators, everyone presents these plans 3 to 5 years. Right. And obviously with that, you cannot think in decades as you do, which is really the ideal scenario. And really personally, we have invested in properties that have done extremely well over the decades. And we have sold others way too early, similar to what you have mentioned. And we are sorry that we did that. The problem with a lot of syndicators is that you have that 5-year time frame and you cannot really think in that long range. And I think that is only a lesson what everyone can learn from you as syndicators is maybe you just need to talk with some of your investors and identify which ones actually want to be more long-term investors, other than assuming that everyone wants to be out in 5 years.
Yeah, because those people are out there too, but you need to be able to manage the deal. I think that's the other thing too, is where you have a syndicator that may not be able to really pull through the management for the long term. So they see a run up in the market, and that's their opportunity to get out and cover up their mistakes. So I think having proper systems in place and being able to manage the deal over the long term is crucial if you're going to attempt to do that.
Anton, on our first syndication, we should have refied the deal. It was a Louisville deal, and we just didn't want to stay in Louisville because it didn't align with our values. All of a sudden, they're mandating Section 8 in Jefferson County. We didn't want to deal with that. We could have refied out that deal. The limited partners would have gotten the majority.
The way they treated COVID too, I was not okay with it. It was too much government tyranny.
So if you're thinking about that long term as a syndicator, try to put in your PPM when you refi. Maybe LPs get some part and the GPs get some part. So then all of a sudden you're covered. The way it was written, the LPs got the vast majority, and us as the GPs are just putting debt on it. It's like those values didn't align. And on top of with the market itself, that's why we exited. That's why it's important to really set your values and set what your core values are. And if something goes awry, it wasn't really that difficult to say, let's sell this thing and make a 35 IRR in 2 years. I mean, nothing wrong with that. We would have loved to hold it if it was a Knoxville, it just wasn't so.
Yeah, excellent point. I think also another very valuable point that you brought up, right? You have done so much business. You have been very successful, yet you have been operating in a 3-hour range from your home base. And a lot of syndicators look all over the country, right? They're always looking for that shiny object, and they are really never mastering any market because they're constantly looking for that other shiny object that apparently is now the best market to be in. And you have proven, as long as you really know your market, you find good deals, right?
And getting that experience with the brokers, being able to talk to the brokers and doing property tours. That's the biggest thing. You need to get out there and walk properties. Don't call a broker and take him out for coffee. Call a broker and call him on his listing or her listing and walk the property tours, because they've got tons of calls and tons of tire kickers. Be serious. Go out to these properties, do property tours. And the other thing, Jake, I would say in this part of the market, man, you have to put in offers quick. I mean, it's slowing down a little bit, but in the last couple of months, we've lost 1 or 2 deals because we're dilly-dallying and saying, oh, we got to go check the interior of the units and all. And we waited. Someone else came in, put an LOI, and got the deal in the contract. So you have to move real quick, but you also have to be able to go and do property tours and network with these brokers in the market. That's
I love getting on site myself, but I got the team out there because I'm in New York right now looking at a deal Friday, and I'll FaceTime in a little bit. I don't need to be there. I mean, they're a lot more qualified than I am when it comes to this stuff, but ultimately, it's comfort level. But I'm like, guys, we're not waiting. Get on site. We're going to scoop this thing and roll. So,
yeah, all great points. So I think you put it in the chat, right? So everyone can look up the information for your next event. So hopefully many will sign up and join you there.
Yeah.
Well, if you are syndicating, man, it's a great place to meet some potential LPs and get your name out there. So I definitely would highly recommend it. So
yes, absolutely. So thanks again, you guys, for joining us. We are now going into breakout rooms. So if you want to hang around, please feel free to do so. Right. So it will be rough.
I got about 5 minutes before my wife kills me, so I'll hang for a little bit.
All right. Very good. So really appreciate it, guys, for coming on and sharing all your wisdom. Great story, obviously. And it's always great to have you. Thank you very much.
Thanks to John, Ronnie, Ferris, and Anton for having us on.
Quite the team here. You guys got a good thing going. Keep it up.
Awesome. Thanks, guys.
Yeah, thanks.
What happens now?
So now we do the breakout.
Brother, I'll see you later. I'm flying to New York early in the morning, so I got to go pack right now.
This
Take care,
is
everybody.
the Maverick salute. There you go.
Ciao, my friend.